Be fearful when others are greedy, and greedy when others are fearful. Famous quote by the one and only Warren Buffett. And in today's video, we're going to take that quote and we're going to actually dive a bit deeper. We're going to unpack that to quantify when others are fearful and when others are greedy. And no, we're going to take it a step further than asking your friends and family. And when you hear your friends and family talking about a stock or the market, that generally is a good sign to go the other way, right? But there's more to it than that. But before we dive in, let's understand the purpose of what we're doing here. Why does it matter? Why does stock market psychology matter? Well, over an investing career, the lifetime of a portfolio, the ability to compound gains is, quite honestly, the name of the game for many people. And if you're able to compound at a slightly faster or higher rate earlier in your career, that's going to net you more money, more gains later on. And stock market psychology is a great way to open the door and understand a bit more about how markets work, market cycles, and when you can get a better bang for your buck in terms of the compound rate and in terms of return in the near, medium, and longer term. So the quote's awesome, but how do you quantify that? No, it's not because your friends and family are talking about a stock or they're talking about this or that or the market and how it's going to go to all-time highs or how it's going to crash to zero. It's not just that. Now, that could be a great indicator. That could be a great contrarian indicator, as we like to talk about. And we mean by that is when you're hearing from people who are not in finance, have no relation, no correlation in their field of work, and they're talking about it. They're talking about stocks or a stock or this sector or AI or all these different things. It's generally not a bad time to start to think to yourself, okay, if everyone's saying all these good things, that means there's probably a lot of greed. Maybe we should start looking the other way, or maybe it's not a time to buy or invest in this. Let's just let it ride. And then vice versa on the downside. Everyone's panicking, fearful. Oh my gosh, we're going to zero. I got to get my money out. Maybe it's a time to start looking to pick up some deals and dollar cost average or add in some extra funds you had lying around if you did. Then there's the media side. And yeah, you start seeing on mainstream media and talking about this stock or the market in the same exact way. That could be a good indicator as well. When the media is talking about something, well, guess what? Who's on the other end? A lot of eyeballs, a lot of brains, a lot of people who are thinking, oh, maybe I should look over here. Oh, I haven't heard of that. Oh, maybe I should get myself invested today. Oh, maybe I should sell. Market's down a lot. That could provide good opportunities, but there's not really a way to quantify it. So let's dive a bit deeper into some data-backed sources. I've got two specifically, and I'll leave the links of these below, in addition to links to TradingView, which is the best or one of the best charting platforms out there that we use here all the time, as well as Lux Algo if you want some of the best, most advanced indicators in the game. Those links will be down below, and you can use these platforms to do a lot of this analysis and dive deeper into this analysis if you wish to do so later on in your own investing or trading or research. The first resource is going to be CNN Business. They have this thing called the Fear and Greed Index. And as of right now, as I'm filming this video, it is 85, which is into extreme greed. It goes from 0 to 100. Okay. We haven't seen this thing I haven't seen this thing as of late get insanely high. Market has been coming off of a bear market. And so we're at the highest point that we've seen in quite some time on this. And we'll get into that here in just a second. But if I go over to the timeline, here's a better representation, more of a graph, right? Because overview is just telling us a snapshot as of right now. The timeline gives you a view of what's happened over the past year. And you can see that we're at pretty much the highest, about the highest that it's been. Why is this important? Well, it's telling us that right now there's more greed, and it factors in 7 indicators. There are 7 fear and greed indicators that factor in to this fear and greed index top line number. Momentum, put call ratios, junk bonds, a lot of stuff that we don't need to dive deep into in this video, but this all factors in to give us a broad picture view of, are investors all in? Are they greedy? Are they buying more? Or are they getting out, running away, looking for other opportunities, or just saying, I don't want anything to do with the stock market? That's what it's telling us. The lower the number, the more people are saying, get me out of here, the higher the number of people are saying, get me in. I want to be involved. So this is a great way to use the Warren Buffett quote and go, okay, well, what happens when we see some of these relative peaks? Back here mid-August, we had this one right here, late November, early December, December 1st, 76, back up into extreme greed. We had February up into 82, extreme greed. Let's go back through those time periods. If I look at the S&P 500, here now we're looking at TradingView, which again, the link to this platform that we use to chart is in the video description box if you want to check it out and sign up. This right here was mid-August, August 15th to be exact, or August 16th was the high. This was December 1st, and this was early February. What do you see? What's the correlation here? Every time the fear and greed index had a relative peak, we saw a relative peak in the stock market over this past year. Now, what we're seeing right now is the stock market's pushing higher. And guess what? The fear and greed index is at the highest level that it has been. So does this tell you that it's a good time to buy stocks, buy the S&P, or maybe at least leave it alone and wait? I'll let you be the judge. Now, if we go back to late September and then even into early or mid-October, we saw some extreme fear. We even got back into extreme fear here in mid-March. Let's look at the S&P 500 during those time frames. Right here was late September into mid-October, and then right here was mid-March. Both were buying opportunities, both were relative lows, and both saw the S&P 500 rally in the coming months after those pullbacks. So you guys see what I'm saying here? You see the point? That when we unpack stock market psychology and start to quantify it with some basic indicators, basic numbers, we're not diving into, insane analysis here. We can get a really good understanding and a really good feel for when there are deals and when there are times to maybe stay out. Things are a bit expensive in a near-term relative sense. Now, obviously, the market can go higher, and did the market actually go higher than all of those peaks when we saw fear and greed get into those extreme greed or those relative highs? Yes, it actually has. But you could have gotten better deals shortly after if you had just waited for the fear and greed index to come back down. You see what I'm saying? So from a compounding perspective, let's quantify this again in terms like a portfolio. Let's say that I am someone who invests $100 a month into the stock market. I have a dollar cost average approach where every single month on the 5th of the month or on the 15th or on the 30th, whatever the date is, I buy $100 worth of an S&P 500 ETF. I do that on autopilot. I have it set up in my broker, great. But maybe I sold my car. Maybe I sold my computer. Maybe I sold a motorcycle. I don't know. I sold something and I've got some extra funds and I want to put those funds to work because I don't need them right now. And I'm not buying anything right now, or maybe I have some extra money left over, or I got a raise, and I'm like, okay, I want to up my investments. The times that I'm not dollar cost averaging, we could start to look at the fear and greed to gauge a deal in the stock market. And if we have extra funds, or if we have extra cash on the sidelines, or if holding cash is part of my portfolio structure, I might want to dip into some of that cash and deploy it when others are fearful, and when the fear and greed index drops very low into those extreme fear periods. It doesn't happen all the time, but when it does, we've seen some substantial moves. For example, from the October lows to where the stock market is right now, literally about, what is that, less than 8 months ago, the stock market's up about 27%. From the March lows to where the market's at right now, it's up 16%. Not saying you're going to capture those entire moves, and not saying that you're going to buy in huge and sell at the peaks. No. But if you could dollar cost average or add some additional investments at relative lows, or when the market's dropping, or when others are handing over shares left and right, you're going to get some deals, and those deals can stack up to increased portfolio gains over the course of years, decades, and a lifetime. Now we'll go to the second resource. That's the American Association of Individual Investors, AAII. This is their investor sentiment survey. So they poll investors and they say, hey, where do you think the stock market will be in the next 6 months? Higher, neutral, lower. Are you bullish, neutral on it, or bearish? And the historical averages are 37.5% bullish, 31.5% neutral, and 31% bearish. Generally, right, the market has a bullish bias over the long term. That makes sense. What do we see in late September of 2022? A one-year bearish high of 60.9% bearish. That is almost double the usual percent bearish bias that we have in the stock market. Tells you that the majority of investors are fearful. They don't believe the stock market's going higher. And so if they're fearful, they're bearish, why would they buy in the short term? And this is playing into that psychology yet again. When we see numbers near floating around the historical averages, it's not as useful. But when we get these extremes, that's what we want to look for. And what we're seeing right now is that on bullish sentiment, we are above historical averages, but not by a ton. So as we were up in the mid 40s, that was up there. But if we start to see this thing get over 50%, that's telling us that we start to see excessive bullish bias, a lot more greed. So we're there. We're definitely greedy, or greedier than we've been. As of right now, we're greedier than normal. That factors in, but it's not as extreme. And to be honest, compared to where the stock market's at, it's pretty impressive that the bullish sentiment isn't higher, given where the stock market and how big a run it's been. This potentially has to do with economic fears and whatnot, but we're not going to dive into that in this video. So you can see how this works. And again, that would have worked very, very well. Again, this pointed to a very fearful period back at the end of September of 2022, what the stock market was doing back around then. It did go a little bit lower for a couple of days, but not much. You would have potentially been looking at buying in like around here. You would have been looking pretty darn close to a relative low in the stock market. And that's what it's all about. We're not about trying to time this and be perfectly right, but it's about when could we start to think about deploying excess capital, if we have it, at times where we're going to look back on in 6 months, in a year, in 2 years and go, I'm glad I did that. I, milked out an extra 0.5% on my portfolio, or I milked out an extra 0.25% on my portfolio. Sounds like nothing, but again, compound that over the course of a lifetime, and those little increments can make a big difference when we're talking the end game. We're talking a lifetime here. Now, there's one more thing that I do want to touch on, and that's this chart right here. This is the psychology of market cycles. Here is a look into the Wall Street cheat sheet, if you will. We have this phase of hope, optimism, belief, thrill, euphoria. Oh my gosh, we all got to get in. Everyone, your grandmother, the media, everyone's talking about the stock market or this specific stock or this sector or this new craze, right? And then it pulls back, and then it starts to kind of bounce and consolidate, and everyone's like, well, we just need to cool off. It'll be back. Don't worry, complacency phase. And then it falls. Anxiety, denial, I'm down so much, panic, oh my gosh, I got to get out of this. And then the capitulation is, I'm out. I have endured too big of a loss. I can't take it anymore. I can't afford to lose anymore. I have to sell. I'm out. And then from there, we see this kind of slow and painful period. People are angry, depressed, before we start to see that next disbelief phase and the rally begin again. This is the psychology of a market cycle. What I want to do is I want to pair up a stock that some of you may be familiar with and show you just how much this looks like that market cycle. Here is ARK, the ARK Innovation ETF. Those of you know who Kathy Wood is, well, here you go. So what we saw was this phase right here, where we kind of had a slight uptrend to that, but also more so just consolidation, nothing crazy. We had the pandemic, then a massive move to those highs. Then what do we have? Complacency. Here's your complacency stage. This is your euphoria stage up here. Complacency stage is right here. And then we started to see those lower highs and those lower lows really break down. And then we had panic, capitulation down into here. And then we ended up going a bit lower, which if you go back to that psychology chart, technically speaking, it does go lower a couple of times before the next rally. Not that it has to mimic this exact chart, but you're looking at ARK and you are looking quite literally at something that is almost a replica of that chart. Now, how much more is it going to stay here? Could it consolidate? Could it go down some more? Yeah, it could do this for a while, for all we know. But what you just witnessed was the perfect up and down and now consolidation, painful, angry stage of a market cycle, of a growth stock, innovation stock, boom and bust, in a sense. And so looking at that chart can be very beneficial when you're starting to gauge, when you zoom out, what's happening. And so that's why I like to use TradingView and pair up the TradingView charts that we can do here, all of our analysis, all of our editing tools, and all the saving watch list, and then pair that up and compare that to the Fear and Greed Index, the AAII Sentiment Survey, and even the psychology charts from a big picture perspective, so we can frame where we may be. By no means do these things have to work perfectly, but it's a great place to start when it comes to understanding the markets and market psychology in your own investing. Those links, resources will be down below in the video description box. Check those out. Make sure you are subscribed here to the TC Trading channel. Consider a thumbs up and share it with a friend if this video is valuable to you in any way. And we'll see you guys in the next one. Peace.